Let's kick things off right now with Sadiq Adatia. He's Chief Investment Officer at BMO Global Asset Management. Sadiq, it's great to have you with us, as always. And I wanted to have that long build-up because it's hard to say there was one reason. There might have been a catalyst for the sell-off, but it did feel like there were a growing number of issues that the market had been grappling with. What was your take on what happened?
Yeah, I mean, you're definitely right. It was this catalyst that took us over the edge. But if you look through the last 3 or 4 months, what we have been seeing is excess consumer savings diminishing. We're seeing adjustment in spending patterns. We're definitely seeing a narrow market led by a handful of very strong companies. And so in that environment, what should have been happening is markets should have been kind of readjusting. We should have been seeing a little bit less strength in the markets. And because we didn't get that, when all of a sudden we got this kind of a short period of time of economic news that kind of surprised people, we get this big sell-off that occurs, right? Rather than having that sell-off over the past year and us thinking more gradually as it's been a pretty healthy market. Instead, we were very optimistic for the first half of the year and now getting very pessimistic all of a sudden. The economy is not as bad as the market thinks it is today, but it also wasn't as strong as the market thought it was but a month ago either. And I think you have to rationalize all of that to say, we're still in a pretty good economy that is slowing down because we've had high interest rates for quite an extended period of time. And the Federal Reserve and other central banks generally are looking to cut rates to start to accommodate that a little bit now that inflation is becoming tame. But we're getting back to more normal market conditions rather than the crazy markets that we were seeing over the last 18 months, where all markets were really continuing to move higher up.
What's the determining factor in the short term, though, if selling, which brought on even more selling, is something that leads to additional selling, even if there's still a case to be invested in the stock market?
Yeah, I mean, that happens all the time, right? We get this overreaction that doesn't stop right when it should, and it continue on for a period of time. I think what consumers have to look at and think about carefully here is, is this a time for us to start looking at potential opportunities to invest back in markets from companies that we saw had done exceptionally well, big heavyweight companies that have good balance sheets, a good theme that they're tied into, that have now been priced a lot more attractive than they were just 2 months ago. And those are opportunities that you don't get too often, but you want to take advantage of. At the same time, nothing wrong with taking profits on things as well and rotating to other segments that have lagged behind as well that should benefit from a cutting interest rate environment, right? But all to say is, we still have to understand that consumers are adjusting their spending and that we are still seeing a high interest rate environment. Even though we're cutting rates, it's still higher than what we would have had, again, in a normal market condition environment. So you do have to be patient and remember that all we've got in the last few days is a piece of a puzzle. And you have to put the whole puzzle together to get the true picture of where the economy's at.
It's likely the market will keep tabs, for example, in the U.S. on the latest jobless claims numbers. Those come out later this week. People trying to get a sense on the health of the economy since that recession we're in the U.S. is now picking up. And I guess we'll watch the mood. I mean, there's already pundits, Goldman Sachs, saying that buying the dip has been very profitable for people over 4 decades. So we'll be able to test the muscle in the market, if you will, in what had been a very strong, it felt like, bull market. And when you talk about the opportunities out there, whether it's in a sector rotation or whether it's coming back to stocks that people wanted to buy just a few weeks ago, that now they might be a little bit nervous to acquire today, what are the kinds of areas within the market that you're gravitating towards in an environment like this?
Yeah, I mean, for us, it's still going to be opportunities within certain areas of the tech space, for sure. Now, again, we have to understand that those are going to have some volatility along the way, but these are long-term plays that we're looking at, not short-term gains. Secondly is, look at areas that have been being down, that have good dividend yields along the way, that can kind of withstand a little bit of this turbulence. But as we come out of this, in a cutting rate interest environment, will look really strong, and multiples can expand again in those environments. I do like the financials. They got beaten up pretty good yesterday. I still like them long-term. I think, what key there is going to be is how hard is the consumer going to get hit? If they're not going to get hit exceptionally hard, then I think that's a great place to be. If they are going to get hit much harder than expected, then maybe not. But I don't think that's the case. I think consumers are going to be relatively okay because by the time they feel a bit more of this impact, we're in a cutting rate environment. And the other thing I would add is look for areas for protection in your portfolio still. Like, this is why you want to be diversified, have exposures like gold, have protection through options or maybe other things to help minimize your downside in the portfolio so that you can stay invested when you have these type of difficult market environments where you have the gyrations coming through on a regular basis.
I want to talk more specifically about the TSX because, as I mentioned earlier, we're going to have to watch what happens in trading today. We are getting back to business after a long weekend, so the S&P was down 3% yesterday, so we have to account for that in trading today, but we could also see a bit of a bounce in U.S. stocks. So we'll watch the minute-by-minute swings, but we had a graphic up earlier that said you're still somewhat cautious in the Canadian stock market. You've talked about some of the reasons in the past around that. If this recession narrative grows stronger in the U.S., what do you think that means for Canada?
Yeah, Canada might outperform if that recession is long-lasting. But if it's short-lived, I still think you still want to own the U.S. over Canada. I mean, again, a lot of those things that we were talking about are still going to be prevalent in the U.S. more than they are going to be in Canada. The themes are important to drive markets higher from here. I still think the U.S. consumer is stronger than the Canadian consumer as well. So even though we're seeing some weakness in the U.S. consumer, by no means are they weak. And therefore, I think you still want to own that theme of stay with the strongest economy, which is the U.S., stay with the strongest companies, which are generally going to be the U.S. companies at this time. But again, nothing wrong with taking a little bit of profit and rotating that around. I think this is a good time to be, looking at your portfolio again and saying, what did I miss out that I can buy now? And what areas can I look at that will give me some sort of protection so I can stay invested in these up and down markets?
Yeah, I mean, just to build on that, even if you're seeing opportunity out there, this is a bit of a whipsaw moment for a lot of people. And I think it's still hard to make a decision sometimes. Something just went down a lot. Maybe if you're looking to rotate, wow, if I had sold yesterday, I would have been able to generate more profit on this. Or what if it's not quite the bottom of what could ultimately be, deemed a correction in the market? So any other advice for people who are just trying to navigate all these headlines right now?
I mean, this is such a great point, and this is why it's so difficult to do this by yourself, because you never know when is the right time to get out and the right time to get in and when the right time is to rotate. I'll give you a good example. We have a global income and growth fund that we manage. Just about a week ago, we went 10% underweight equities. Because we had seen all of this looking like this could play out to be a little bit negative. We're getting into the September, October periods that are going to be a little bit more negative on the markets. We didn't see a disastrous environment, but we just saw that we could see some rotation and some pullback, and that's what we did. Now you can start adding back on these dips, right? Coming through gradually and slowly, because we don't want to be 10% underweight equities long term, but short term, that's what we saw. So important thing is, right, always to remember what's that trigger point that you want to get, adding to your portfolio, and what's that trigger point you want to slowly get a little bit out of and take profits. And you have to be resilient on that. You have to follow those patterns along the way, because when the time comes, it's a lot harder to make that decision at that point in time, because you think it's either going to continue going forward or continue to decline. And I don't think today's example, people are going to see a market bounce back. I don't think it's going to be as strong as people think it's going to be yet still.